Good afternoon, everyone. Thanks for joining us this evening for a webinar. We're going to go ahead and get started in just a moment.
Well, good afternoon, everyone. Thank you for joining our Market and Investment Update webinar today. I'm Jeff Carbone, Managing Partner at Cornerstone Wealth Group, joined by our Chief Investment Officer, Cliff Hodge. Good afternoon, Cliff.
Good to see you, Jeff.
Well, today we'll continue to share some insights on the market, the economy, along with the positioning of our portfolios. Cliff, Sean, and Craig Rubrecht held a podcast the other day on kind of the mid-year market update. We also sent out the commentary for the mid-year. It was discussing the shutdown, the reopening, and recession. If you have not had a chance to listen or share the session with friends and family, we would highly recommend you do so. Or if you have not had please visit our website or send us an email or give us a call and we can have one sent out to you. I'm going to get started here, and there's a folks dialing in, so it's kind of slow down for a couple seconds. But as we get started, markets hit all-time high. COVID-19, not just in China, goes to the US and globally. The world basically goes into a global shutdown. Bull market comes to that abrupt end. We go through the shortest bear market that took place with a 35% drop, 50 plus million unemployed, which came to a 15% unemployment rate at the height. The Fed balance sheet grows to over 8 trillion. That is $8 trillion. Stimulus package of another 2.3 trillion. The helicopter money is sent out to keep this economy going. We saw rent, mortgage, car loan, student loan forbearance put in place. We saw additional unemployment benefits deployed. The reopening begins. The resurgence of the virus as schools restart. And the markets hit all-time highs once again. I can keep going, and Cliff can share a bunch more, but could we all imagine this has taken place in just less than about 6 months? It is certainly enough to keep all our heads spinning. As we now come close to the end of second quarter earnings, and Cliff, I think you said about 95% of the companies have now reported. I mentioned the markets are hitting all-time highs, but we see those valuations that are really looking to start and are looking a bit frothy in many sectors across the board. The resurgence of the virus as the US economy has reopened and our children are back in school or back at college, we're starting to see it's an ongoing reminder that the virus is not behind us, and the summer heat that we thought would possibly curb the spread has not taken place. We're continuing to see the trials with drug and pharmaceutical companies in search of that vaccine. In fact, I'm not sure if many of you have heard, but Russia does have claims that they have a vaccine. And I have heard that they are willing to take volunteers. Cliff, are you going to be one of those volunteers, and we can get you a flight to Moscow if you are interested?
Yeah, while it sounds appealing, Jeff, I think I'm going to take a hard pass on that one.
Well, I think that is wise. The economic data in some areas continues to improve, as we will go over today, but the signs and signals in other areas are of concern. Election season now about 75 days or less away. We're in full swing. The DNC started this week, and we've got the RNC starting to take place next week. With all that is going on, in the world, we want to remind you our mission at Cornerstone is to provide clarity and confidence as the cornerstone of our clients' financial lives. With all that said, Cliff, I want to get started with your presentation. Let's go into some thoughts on the market.
Thanks, Jeff. And can you see the presentation on my screen here?
We are good to go.
I tell you what, man, after taking a month off, you didn't miss a beat. Nice job.
Well, thank you, Cliff.
Okay, so we will start, as we always do, first just taking a look at various returns in the markets, sectors, and style factors that we track on a daily basis. And since the last time we all got together, we, against all odds, have gotten back to all-time highs in both the NASDAQ and the S&P 500, with the Dow Jones still just a few points off of its all-time highs. From a sector standpoint, obviously technology, discretionary, consumer discretionary, and communication services, which are where the FANG stocks happen to be, are all very positive for the year and year to date. Whereas at the other end of the spectrum, the cyclicals, energy, financials, industrials, which are industrials are playing catch-up mode here a bit over the past 3 months, still all down pretty significantly year to date. From a factor perspective, again, it's growth and momentum. Quality has inflected positive here recently, but the high yield, the value, the high beta trades still largely underwater. So here's just a one-year view of the S&P. As Jeff mentioned, the fastest 35% drawdown in history, and subsequent new bull market, if you want to count that. Marginally setting new highs here for the S&P as a new bull market. That remains to be seen. What upside we have from here, especially with the some windows of what we call window of risk opening up. I've got some slides here that we'll look at. The impact of the stimulus, the fact that we were not able to, that our congressional leaders were not able to get something additional done. We still think they likely will, but the market may have to force their hand. But we'll just see how reliant the economy has been on the stimulus. But meanwhile, we talk about this in the letter and in the podcast, but that disconnect, that dichotomy between the stock markets at all-time highs and then just the dire economic picture. It's certainly unprecedented, is the most overused buzzword of 2020. But from a PE evaluation standpoint, we're still at nosebleed highs from the 2000 bubble. But meanwhile, from an earnings perspective, so we still believe fundamentals ultimately do and will matter to the markets. We've had about 95% of the S&P 500 companies report, just a handful of retailers predominantly left to go. And growth, earnings per share growth down 33% essentially year over year. Worst quarter going back to the great financial crisis in 08, 09. But you can just see a lot of the damage here, especially in some of those sectors that have underperformed. Energy down 164%, industrials 84%, consumer discretionary down 71%. The thing that saved that is Amazon happens to be categorized as a consumer discretionary stock. This is, hotels, auto manufacturers, so on and so forth fall in that bucket. So what we've seen, this chart is pretty interesting. We talk a lot about how narrow this rally has been, where it's just been a handful of these mega cap predominantly tech and growth stocks that have powered returns for the broader markets. So the 5 FANG stocks are up 35%. This is maybe a week or two old, but still the point remains the same. The S&P 500 is essentially flat, up slightly, but the remaining 495 companies down 5%, right? So just goes to show that without these leaders, I mean, we would be in a much different situation from a return standpoint. And just how nutty has it gotten? I saw this chart and my jaw almost hit the floor. So 6 stocks, the FANG stocks and Microsoft, now exceed the total market cap of Canada, entire European markets. So France, Germany, this is the UK, here the FTSE, Spain, and what's not pictured is also Mexico. These 6 stocks are now over $7 trillion in market cap. Apple just eclipsed the $2 trillion market cap line, but just goes to show just the eye-popping nature of what we've experienced here year to date, as there is just continues to be so much optimism and so much money flowing into the system that with yields so low, it continues to find its way into the equity markets. So, we talk about sentiment, we talk about flows. Again, the put-call ratio is something that we track quite closely. This just, again, is the number of puts divided by the number of calls on all equities. So when you get to these extremely low levels, typically, that's when you have a higher probability chance of a correction. Right. So, you contrast where we are today down here with where we were at the end of March. It's not really used as a timing tool, but it can inform you your views on the magnitude and how much the boat is all tilted to one side, so to say. Another sentiment indicator that we track, this is the National Association of Active Investment Managers. So these are large institutional managers. They, this is not how they feel, this is how they're positioned. And so, we can see that they are back fully positioned net long over 100%. So even starting to put a little bit of leverage on. Not seeing these levels since 18 and late 17, again, in those bull markets. So these are, again, contrarian indicators that we look to be on the other side of, but gives us a feel for how the street and how positioning is put together by and large from different viewpoints.
Thanks, Cliff. When you brought up that chart about the FANGs, the Facebook, Netflix, Google, Amazon, etc., being larger than the Canada, Europe, Britain, etc. It is mind-boggling that these companies, and again, some big crossing points this week with Apple crossing over $2 trillion of valuation. I think it pulled back, and I think it's back over $2 trillion at this point. We mentioned earnings, and I think about a couple big, you had Target and Walmart, some major big quarter for both those retailers, but guidance is of a concern for both. And I think Walmart sold off. So it's, a lot of where things are good or improving, there's still a lot of the uncertainty that's out there. So why don't we jump into some of the economic and the economic data that you've been watching the last few weeks?
Yeah, absolutely, and great segue mentioning those retailers. We'll talk a little bit about stimulus, but the Walmart CEO on their earnings call, they had one of the best quarters on record from a same-store sales growth perspective. But he said we're already seeing it drop off as stimulus continues to drop. So that's the big risk in the immediate term that we're tracking. But from a high frequency economic data standpoint, this is the update from the New York Fed's weekly economic index. again, which is an index of 10 high frequency data points. You kind of seen this trajectory pick up, but now, really as we move into August, we're starting to see that slow down, right? And in our view, it's not a coincidence that the stimulus money has started to run out. We're starting to see that take effect in the real economy. There's a lot going on in this chart, Jeff. But what we're looking at, one of our research partners, Hedgehog, put together this high frequency data tracker, similar to the New York Fed, but they're color coded, right, as a way to understand rate of change. So are we getting better? Or are we getting worse? On the jobless claims, that's a big one that we track every week. You can see where we were back in May. While the economy was shut down, over 2 million claims a week. Last week, we dropped below the million mark for the first time all year. But unfortunately, on the release today, we were back up over 1 million jobless claims today. So this data point is going to start turning a lighter shade of green or even red, depending on the way things continue to move. But by and large, this lines up with what we're seeing from the WEI, right? So TSA, a lot of folks have questions about airline stocks. They've been beaten up. Are they buys? Do we sell them? And obviously interest here in the Charlotte area being the big hub of American Airlines. But you can see TSA throughput essentially was nothing. It was down 90% during the COVID shutdown, but has gotten better, but we're still down 71% from a TSA traffic indicator. So still quite a long way to go. Public transit data is looking a little bit better. Open table is pretty interesting here as well. We've gotten back from, again, essentially no activity now to down about 54% year over year. So things are getting better so far, but again, our hypothesis is that if Congress is unable to get its act together and get some more stimulus in areas where it's needed, that the risk of that W, right, rather than the V shape recovery is more probable. The other thing I want to draw everyone's attention to here, these bottom data points are really all around banking and credit. So this is important because credit is really the lifeblood of our economy. And what we've seen is that in various measurements here, so total assets, credit cards, auto, consumer loans, so on and so forth, the rate of the growth rate year over year is beginning to slow down here pretty dramatically, really over the past couple of weeks. And it's interesting because typically with credit growth, you see it stall out prior to the recession hitting. The fact that we're seeing it coming 6 months after the shutdown and the outbreak is certainly not a good sign. Part of the reason for that is because banks, according to the Federal Reserve quarterly survey that they put out, are tightening their credit standards, so that it is becoming incrementally more difficult for folks to obtain credit. This is for commercial and industrial loans. You can see the pattern here in 2008 and 91. These are all recessionary periods. We're kind of following along that same trajectory, right? We need to see this begin to turn back down. We're seeing it in C&I. We're seeing it in mortgages. Pretty much to the same degree, other than 08. So these are not the best signs for again the credit, the flow through of credit to the economy, and the risk here is that it creates what we call a negative feedback loop, right? So standards get tighter, it's harder to get a loan, demand falls off, so there's less demand out there for credit. You have the delinquency cycle begin to flow through as these rental and foreclosure moratoriums roll off the books in the fourth quarter and at the end of the year, and it just is a negative cycle that feeds on itself, right? That's what we saw in '08, and that's why things got so bad. One of the reasons why things got so bad. So, we're certainly going to be keeping a close eye on the trajectory here. A little bit long-winded this week, Jeff, but it's been a month, so we're going to cover some data. But kind of moving on, earlier we talked about the risk of the stimulus, and we can see that here in this indicator. So what this is real personal income growth year over year for each recession going back to 1970. So one of these things is not like the other, right? Every other recessionary period, income growth either stalled out or actually went negative, right? 1973 being the worst. But what we see this year is that income growth has actually grown by 30% year over year, which, the only explanation that I can really come up with for this is the amount of stimulus that has gone through the system. So we can see that here in the form of government transfer payments as a percent of total income. Really over the past, we'll call it 20 years or so, it's averaged 15 to 17%, shot up to over 33% of income. So a third of our national aggregate income was just a transfer payment from the government. Now that has since back down to about 25%, but it's a very significant number here nonetheless. And it's been, I'll give them credit, it's certainly helped get us through this shutdown period. But the risk now, as these things go away, right, you can see this real disposable income number in the light blue. If you strip it out, if you strip out the transfer payments, you can see that in the dark blue, down roughly 10, 15%, which again would correspond to one of the worst recessionary periods ever. And the risk now is that, as these unemployment benefits are at 3-month lows and continue to worsen and worsen, even though we have an executive order that boosts it by an additional $300 a week, we've seen estimates that that's only going to last a maximum of 4 to 6 weeks, depending on how the process flows through the system. But the risk, and we're already beginning to see this flow through the data, is that the big boost we got, this is retail sales. So this is one data set that is supremely impacted by income and the transfer payments. As that rolls off, you'll start to see this, slow or even potentially go back negative again, like we had in the shutdown. So we're seeing it in retail sales. We're seeing it in manufacturing. This is New York manufacturing. Again, one data point doesn't make a trend, but this is not what you want to see for a V-shaped recovery, Jeff. So we've hit on this before, the fiscal cliff. The benefit expirations really topping up. I mean, the unemployment was a huge one. So we will see. We still think Congress will ultimately pass something. It will likely be less than CARES Act 1.0. So even there, it's from a rate of change perspective, could have a negative impact. But what we do know is that there is the other side of the coin, right? The printing and the stimulus is great to get it in the hands of folks that need help and can't put food on the table. But we know that every dollar we pay out now is going to goes to the deficit and is going to have to be repaid later at some point. So this just shows the relationship over a long period of time between the fiscal deficit to GDP, which we're on pace now to be at the greatest deficit level since World War II, assuming they pass another CARES Act. But the relationship between the deficits and the dollar, right? So this goes back to the positioning in the Quad 3 environment that we'll talk about here momentarily, Jeff. But as you can see, even though the dollar has come off a bit from its highs, if this relationship holds up as it has historically, there could be a bit more to come. right? Which will is how we're beginning to position in anticipation of that trend continuing.
Well, thanks, Cliff. And yeah, like you said, and we want everybody to realize we know there's a lot of information that we're sharing. But you use the word again, and probably the most we could say the word unprecedented. Truly, I think as Jamie Dimon from JP Morgan put it, this is the year to use that word, right? It has truly been an unprecedented 2020 with all that's going on, and that I already mentioned. The fiscal and monetary stimulus that has been put out, this is truly the time that we can use that word. I know what I've seen when you showed the tightening of credit or banks tightening up. I know when I'm talking with clients, and I'm sure advisors are hearing the same, or clients are hearing it. Things are tightening. Banks are getting tighter. They're increasing what they want to proceed with a refinance or a loan, especially on the business side. There's definitely a heightened concern that things are, and the free flow of money is tightening while interest rates are at these all-time lows. So again, a lot of movements. I know we're hearing it from clients, whether they're business owners or just on their personal side. And again, we realize there's a lot of data and a lot of information we're sharing, but Cliff, why don't we proceed into kind of the positioning and the why we're positioning where we are.
Yeah, absolutely. And I would encourage folks too, as if you experience issues with credit or, getting credit or, whatever it is. I mean, I'm a data junkie, but we also appreciate the anecdotes as well.
Well, and Cliff, before you jump through to this next slide, just a reminder for everybody that if there is a question, my bad, I should have brought it up earlier. Of course, anybody that's listened on the call before, go to send us a question. We'll try and get them answered in just a few minutes. And if not, send us an email. We'll personally respond to them as well. So Cliff, sorry to jump over, take your thought process away there.
No, not at all. Not at all. So a quick review. We are, of the opinion that the economy is now transitioned into or out of this quad 4 phase, which is where both growth and inflation decelerate at the same time, into what we refer to as quad 3, stagflation, where growth remains slow, again on a year-over-year basis, but inflation begins to base and pick up. So what does that mean for portfolios? On the equity side, it's the barbell, right? So tech, growth, quality, paired with defense and low volatility. Utilities, REITs, we're being selective with real estate at this point, but we still have some exposure there. We're largely out of financials, materials, consumer staples, things that are a bit more cyclical and don't have pricing power. On the fixed income side, it means investment grade, so high quality credit, TIPS, which are inflation protected securities, and some treasuries. So we've got exposure to all of these on the fixed income side. Nothing in the way of convertibles, preferreds, BDCs, so on and so forth. So again, just to review, historically quad 3, when we look at the 4 different macro environments, quad 3 is fairly flat. Coming out of quad 4, obviously we think the market has gotten a bit ahead of itself here. But by and large, we think the major opportunity again is to position ourselves for this, resumption of inflation, predominantly driven by the dollar, right? So you can see here just over the past 3 months how quickly the dollar has fallen as we have outstimulated the rest of the world. It's always a relative game, but we continue to believe that this trend will persist. Yields as well are not confirming this reflation narrative. We were down here at all-time closing lows just about a week or so ago. We've rallied a little bit, but rolled back over. We actually, I think, finished the day off at about 64, 65 basis points. So coming back here. got ahead of myself there. High yield spreads, which again is just the difference between interest rates on junk bonds, high yield bonds, relative to their treasury counterparts. 500 is kind of the line in the sand. Where north of 500, there are concerns about credit, and we got right to that point and have kind of peaked back up here. So again, another signal that we're going to continue to monitor. But as the dollar has fallen, that's really given a boost to commodity prices, right? So if you think about what makes up, this is the CRB index, it's energy, it's grains, it's livestock. I mean, input costs, right? So that's another thing to consider, that, a lot of the input costs for a lot of these producers are going up. They're going to have a tough time in this environment with pricing power. So that's, another bit of a headwind that markets are going to have to work their way through. But on the other hand, there are opportunities to either own commodities outright, commodity producers, companies that have a high correlation or high R squared to rising commodity prices. So we've started to make those pivots within our more tactical portfolios. Gold, another one that has gone gangbusters. I mean, we got near 2100, pulled back and are kind of on that same path forward. But again, this is another place where we have exposure across the book with precious metals. Copper, another one, part of that index, breaking out here with industrial metals moving higher. One area that's been a little bit of a laggard, we're watching this closely, is energy. Right, so there could be an opportunity for a catch-up trade here as we continue to move through. But still we've come back a long way from when that day we went negative back, I believe it was May 1st, Jeff. I'll never forget that. But by and large, that's what we're doing. We're combining that offense and defense. We have a lot more detail on the mid-year update, both the letter and the podcast. I would encourage folks to read through that, or at least have a listen if you can spare 10 or 15 minutes. And we'll certainly have a lot more to come as Jeff, you mentioned earlier, election season. We're getting some questions on that. We've had a couple of calls already with some of our folks in DC. So there will be much more to come on the election front. So please stay tuned.
Well, again, Cliff, thanks. I mean, again, I know, like you said, a lot of data that it's been a month, so we had to throw it all, a month of data almost into 30 minutes. I think we're pretty good to do that. So, no, thanks, Cliff. I mean, like I said, we know there's a lot, but we want to continue to do these calls to kind of keep what we're thinking, why, what we're watching, as you've heard, talking about our process, and again, what we're continuing to watch and the adjustments we're making. There's always that why behind it. We did have a question come in, Cliff, and this is a little bit of the FANG stocks that we were talking about, and not all FANGs, but is the tech sector overvalued, and will it be able to continue to provide growth?
That's a great question. So the short answer with some caveats is absolutely. When you look at traditional valuation metrics, the price of sales, price to earnings, EV to cash flows, you name it, they're all very stretched. Now there are pockets within technology that are not quite as overvalued, right? So there's certainly always something to do, but there's a reason for it, and that's because it's one of the few areas where you're getting real growth. Right, so the market always values what is dear, right? So there's not a lot of companies. We saw that earnings slide. I'll go back to it. I mean, there are not a lot of areas in the market that are providing real growth, and so the markets are paying up for technology and some of these other areas that are growing. There are also technology is so pervasive throughout our economy now as well, that a lot of the disruption that's flowing through the system is all related on technology, and there are a lot of exciting things and opportunities. So yeah, overvalue doesn't mean that the rally is over with, but it does mean that when this whatever catalyst, whether it's the election, whether it's China, whether it's something we don't know about, when that does come, it just means that the reversion to the mean will likely be swift and could be fairly severe. But we've got a process, we have a plan in place to manage that and to look for opportunities. So I don't by any means think you need to go out and sell all your tech stocks. But I would say, for those who, if you manage your own portfolios, or you have friends or family that maybe don't have a plan of what you would do when and if things change, I would definitely recommend spending some time putting that together. Or better yet, allow us to do that for you.
Well, thanks, Cliff. Again, great info, a lot of detail. I say as we come to a close here, as we continue to see, hear, and read about the markets hitting the new highs or all-time highs, we remind our clients in meetings and these webinars that a significant amount of the recovery and rebound is taking place. Cliff, as you've told it, as we've looked through the monetary and physical stimulus that has been deployed from the Fed and out of Washington, with yields dropping, as low as they have gone, investors tend to go in search of higher yielding investments, which in many cases means a shift towards riskier or higher risk investments that may not always be aligned with your overall plan. As we see confidence improving with consumers and through businesses and through analysts or investors, there are still areas that can shake the confidence pretty quickly and add that excess ongoing volatility. We can continue to talk, and we will continue to talk about the virus, for it's not gone. Things that are popping up and have not gone away, the trade issues with China. Let's not forget Brexit, which has not been in the media, but is a big part of the media, but is a big issue that is out there right now. You've heard us talk about the elections. Certainly going to be an interesting time as we're in the election season. All these areas, we're keeping a sharp eye, and we're continuing to follow our process as you continue to hear Cliff, myself, and the rest of the Cornerstone team talk about the 3 Ps, the planning process and having the patience to help our clients remain well-positioned now and for the long run. I want to thank you all for joining us today. Remember to visit our website. As Cliff and I both mentioned, if you have not listened to the mid-year update, please, again, visit our website, or we can send that to you. I hope you all have a great rest of the week. We hope you stay healthy and safe, and we will talk to you in our next webinar. Thank you, everybody.
Thanks, Jeff. Thanks, everyone.